You've spent the last 30 years building a $2 million retirement nest egg. You think you're all set, and that's great. But here's the problem. The wrong withdrawal order when you take money in retirement could end up costing you hundreds of thousands of dollars in unnecessary taxes. Or even worse, it could end up draining your retirement much quicker than you originally thought. Today, I'm going to go over the exact situation that we've seen time and time again wipe out retirement plans, and the exact 3-step scenario that we use to navigate the situation. Before I jump in, I just want to ask, if you find these videos to be helpful, take a minute to like and subscribe to our page. Right now, there are probably many retirees that are following advice that could have been acceptable a couple of decades ago, but could actually end up being very detrimental to their plan today. The reason being, following the conventional wisdom when it comes to retirement withdrawals is not a one-size-fits-all scenario. And unfortunately, you might not realize this until it's too little, too late. Meet Jane, a 68-year-old teacher from Ohio who thought she did everything right. She accumulated over $1 million in her 403B over the course of her career. She followed advice that had been given to her at some point, which was to spend down her taxable assets first and let her 403B continue to grow. 5 years later, Jane ended up getting hit with a tax bill that made her sick to her stomach. She owed $15,000 on distributions that she was forced to take out. Money that she did not necessarily need, but had to withdraw due to her required minimum distributions. And now, she was left owing a hunk of it to Uncle Sam. Jane's story isn't unique, unfortunately, and in fact, we see it happen more often than not when retirees neglected to plan for this situation early on. Here's what Jane didn't know. There's a mandatory withdrawal rule called required minimum distributions, which occurs at age 73 as it stands today. And if you follow the old advice of let your tax-deferred accounts continue to grow, you could end up facing RMDs that could cause a real tax nightmare. But here's where things get interesting, and might actually completely change the way that you think about retirement planning today. Research by Fidelity has shown that retirees that use differing withdrawal sequences can actually end up cutting their lifetime tax bill by almost 40%. Yes, you heard that right. Cutting taxes by almost 40% just by simply planning and executing and utilizing differing withdrawal strategies. So what are they doing differently, you might ask? Well, instead of using the common sequential withdrawal approach, they might end up utilizing what we prefer to call the proportional withdrawal approach. Think of it like this. If your taxable investments equate to 30% of your overall holdings, your pre-tax investments equal 50% of your overall holdings, and your Roth investments equal 20% of your overall holdings, you end up withdrawing proportionately across the 3 different types of accounts. Now let's get back to Jane for a minute. Remember the unexpected tax bill that she faced? Here's something she could have done differently. She could have considered Roth conversions over the course of a period of time before she reached RMD age. By converting just enough from her traditional pre-tax retirement accounts to fill up her tax bracket, she could have ended up paying taxes at a lower rate as opposed to being forced into higher brackets later on. This strategy is also known as bracket filling and could end up saving folks a significant sum of money over time. With this strategy, we often find that timing can be crucial, and there are certain windows of opportunity to be on the lookout for. The optimal timing, in my opinion, occurs when you might be in a lower tax bracket between retirement and RMD age, in which case you could potentially have a number of years to make these changes before you're forced to take withdrawals. There is a caveat to be aware of, though, when it comes to Roth conversions. There's a 5-year waiting period on each dollar that you convert to your Roth accounts before you can use that money tax-free and penalty-free. With that, if you decide to wait too long and procrastinate, you could end up facing a cash crunch at some point. When used alone, these Roth conversions, depending on one's specific situation, could end up being a particularly useful strategy over time. But there's another approach that I would actually argue to be dramatically more impactful. Let me explain to you how this could play out. During Fidelity's research, they drew a comparison between 2 identical retirees. Each retiree started with a total of $500,000. They had $200,000 in taxable accounts, $250,000 in pre-tax accounts, and $50,000 in Roth accounts. Retiree A used the conventional wisdom as far as his strategy was concerned when drawing down retirement money, and retiree B ended up using the proportional withdrawal strategy that we spoke about earlier. The end result here is that retiree B ended up saving $23,000 in lifetime taxes through retirement when compared to retiree A. They had the same exact starting point, but the end game was a little bit different. And while all that might sound great, here's where I see the light bulb turn on. Imagine the emotional aspect of feeling more in control of your situation by planning with intention. Having an understanding of your tax planning situation and the overall plan and strategies that you've implemented can help you feel this control. A simple way to think about this is by breaking your retirement spending into 3 buckets. Bucket 1 covers years 1 through 5 with more conservative and liquid investments. Bucket 2 is more moderately growth oriented, and that'll cover years 6 through 10. And bucket 3 is for years 10 and beyond, and that's where you could consider implementing your long-term growth strategy. This isn't just about organization of your assets. This is more about gaining psychological confidence and feeling in control of your assets and spending when you could go through times of market volatility or downturns. In the event of a correction or a significant drawdown, you could actually end up feeling okay knowing that you have a plan in place that accounts for different times during retirement. Now combine the situations we spoke about earlier by implementing your bucket strategy in tandem with your particular tax planning strategy, and you could be surprised at the results. Although everyone's situation is different, a basic example of this goes as follows. Utilize bucket 1 to manage your tax bracket, utilize bucket 2 for your Roth conversions over time, and utilize bucket 3 for your long-term and potentially tax-free growth. Each withdrawal decision here serves multiple purposes, not only meeting your income needs, but allowing you to withdraw tax efficiently over retirement. And there's one more layer that could actually amplify things even further. Take into account here that higher income doesn't just mean higher taxes, but it can also mean higher Medicare premiums as well. These income-related monthly adjustment amounts, or IRMA, could end up adding thousands of dollars to your healthcare costs over time. Understanding the connection here can be crucial in making a plan that allows you to avoid hitting these thresholds. In this event, you're not just saving on taxes, you're also potentially saving on somewhat hidden costs that could eat up at your retirement savings. And this brings me full circle, because every dollar that you save, whether through taxes or other costs, are dollars that can remain invested over time. Each year that you can extend your retirement income is another year that you might have more peace of mind. A quick but rather important reminder here. When it comes to your RMD or your required minimum distribution, there could be penalties associated by not withdrawing properly. If you miss a required minimum distribution, the IRS can impose a penalty of up to 25% of the amount that you should have taken out. To be clear here, that's not just a 25% tax. That's a 25% penalty in addition to the taxes owed on the amount that was supposed to be withdrawn. And these RMDs start whether you're ready or not. As mentioned earlier, this year, they start if you turn age 73. Reflecting back on the Fidelity research that we spoke about earlier, where retiree B ended up saving $23,000 in taxes over the course of his retirement was great. However, I'm not as focused on a number, but rather creating flexibility for your overall picture. And flexibility is what I feel could be one of the most important parts to your retirement plan. For every day spent delaying or exploring making the decision to implement these strategies, your window of opportunity to implement them could be shrinking. The earlier you start, the more time and flexibility you have to consider which strategies might be best for you. And if you're taking RMDs already, don't worry. The window of opportunity is not closed. On the other hand, if you're years away from taking your RMDs, that window of opportunity could end up being tremendous. Regardless of where you're at on your journey, exploring these situations and understanding which strategies might be worth it for you could end up being time well spent. When strategizing with our clients, we don't just focus on one piece of the puzzle. We look at a multitude of things, including income planning, tax planning, Medicare planning, and investment management, among other things. Variables like federal taxes, state taxes, and Medicare surcharges could end up having a rippling effect through your withdrawal decisions. We like to think of it by saying that we're not just here trying to manage money, but rather orchestrating a symphony that plays out over the course of decades. And the beautiful thing is, once you have a plan in place that makes you feel confident, the things that might have felt crazy and complex earlier in life might feel a lot more simple and relaxing now. And I want to make it clear, you don't need to be a tax expert to implement these strategies. You just need to follow a simple framework. To start, Some things you might consider include regular review of your tax brackets. From there, if it makes sense for you, you might consider filling up those lower income tax brackets with Roth conversions. By using your different income sources strategically, you can end up building a plan well in advance of taking your required minimum distributions, as opposed to getting hit by surprise and just taking them as they come. And here's a mindset shift that I've developed after doing this hundreds and hundreds of times. Having a full understanding of what your withdrawal strategy is could actually be more impactful than what your investment strategy is in watching your retirement play out. You might have what you think is the perfect portfolio, but withdrawing from the wrong sources at the wrong times could end up being detrimental to your overall picture. Take a moment right now to look at your assets. How much do you have in taxable accounts? How much do you have in pre-tax accounts? And how much do you have in your Roth accounts? If you haven't taken the time to look at what your RMDs might be when you reach that age, or what implementing Roth conversions over time could do for your overall situation, it might be time for a comprehensive review. Some people celebrate retirement, and others go through it completely stressed. I believe if you've spent your whole life working and saving diligently, putting a plan in place that brings you confidence is worth it over the long haul. The strategies that I've shared today aren't just about saving money. They're more about understanding the tools that are available and seeing if they make sense for your particular situation. One tip here, don't let the complexity intimidate you. And certainly don't let perfect be the enemy of good. Start where you are with what you have and take one step forward in developing a withdrawal strategy that works for you. Because at the end of the day, this isn't about withdrawal types or bucket strategies or money at all. It's about creating your own freedom. It's about putting a plan in place to help you enjoy the retirement that you deserve. The choice is yours, the knowledge is here, and the only question that remains is what will you do with it? If you're looking for more information on Roth conversions, check out our next video here.